The digital boardroom has changed the way how board and senior management meetings were done significantly. So far, these meetings were typically prepared with the help of Excel, and then the data was extracted to PowerPoint, where the information was visualized. The problem is that this data is static, and if questions came up which had not been prepared upfront, they couldn't be answered. And as you can imagine, these questions were the to-dos of the next board level meeting in 2 or 3 weeks from now. This behavior changes completely with the digital boardroom. Now you can do ad hoc and real-time analysis based on the 3 screens and analyze the data on the fly on any dimension. To give you an example, a board member might want to know the impact of a 2 or 3 basis point interest rate shift on the return on equity of the bank. But let us have a look directly in the boardroom how these questions can be answered on the fly. So return on equity is red, which means we have an alert. And Joseph, could you explain a bit more the root cause?
Yes, for sure. First of all, what we are seeing in this graph is that the return on equity is below the threshold. We have a threshold of 4.5%, and we are also performing worse than the competitors. So now I'm doing a deep dive analysis. We have here the Explore screen, and here I can analyze the return on equity across the various business lines. So for overall, it looks fine. The return on equity is stable. The net income and also the net interest income is stable, and the risk provisions are only increasing slightly. Now let's have a look at commercial banking. There it also looks very stable. Return on equity is stable, net income and net interest income is stable, and the risk provisions are even decreasing. So there seems to be no problem in commercial banking. Now let's have a look at retail. How is the development of retail? Here we have a significant decrease of the return on equity, going down from 4.8% to 3.1%. The net income is still stable, but the net interest income is going down. And the reason for that is that the risk provisions have increased significantly from 1.3% to 9.1%. Now we can have a look at the impairment provisions for the top 4 countries. And what we can see here is that there seems to be a problem in Germany. So the risk provisions in Germany are the highest. I will go now for the Explorer. I open the Explorer and I will deselect now the other countries. UK, Sweden, and also Italy. And what I can see immediately is that the risk provisions are increasing over time. And I want to do now a deep dive analysis. So I add the business line. We have already seen before that we have a problem in retail, and that's exactly what the graph is saying. So I select now retail, and as an additional dimension, I add also the product. So what I'm seeing now is that I have the biggest problem in mortgage. And I want to visualize this now on a map. I can see the map of Germany overall, and now I'm selecting retail, and I can immediately see that there is a problem in Frankfurt. So we have the biggest problem in Frankfurt for mortgage loan. That's it.